Sasha, I want to talk China with you first. So exports look terrific on the surface of things. Right. Chris tells us that China is actually in a recession right now and things are ugly, ugly, ugly. Yeah. Your view?
Yeah, I'll agree with Chris. I mean, my own estimates of growth are that China's somewhere between 4 and 5% as of the end of Q4 of last year, and probably closer to 4, which would be below trend growth and technically recessionary levels. Those exports were highly flattered by base effects from the Chinese New Year's holiday last year. If you look at Q1 over Q1 of the last year, and that hopefully cancels out that base effect, we're still down 10% year over year on exports.
Sasha, does the absolute number matter, or is it the trend line? I mean, if it's 4%, and it has been 4%, the rest of the world's accommodated that.
Right. You know, I guess it's perceptions versus reality, right? I mean, if we have a growth target of 6.5 to 7%, which is extremely aggressive, and we have an actual rate of growth, by my estimate, much lower than that. What does that tell us? It means that monetary and fiscal stimulus are probably going to have to pick up the differential between that, because your average Chinese guy on the street, it's not going to feel like 6.5 to 7% growth. And we've already seen that, actually. We've seen the bump in the PMIs so far this year, which has come from a very significant stimulus effort from China in Q1.
Yeah, and the PBOC is trying, I guess. Well, Chris made the point that this is making him very tentative on some other emerging markets. Right. Where should we be avoiding where it looks okay to you?
Right. You know, the way it looks in Northeast Asia, and China is very much part of that. These guys are the canaries in the coal mine of global demand. We've heard international policymakers warning about the state of global demand. There's nothing good happening when you look at export indications and demand indications for all of Northeast Asia. So these guys are going to be probably pursuing further monetary easing, either via the currencies or interest rates, probably via currencies. We're in a bit of a lull because the U.S. dollar has been weakening off, but I think we may have some downside yet for a lot of EM. What's looking more attractive is maybe some of the LATAM guys, because we've had a stabilization in commodity prices, and there's been a lot priced into them already.
Chris, to wrap all that together, what it appears to me at least is a bit of a head fake, because we've had a weaker dollar. Things have stabilized in China. Do you expect that to continue through 2016?
Not through the rest of 2016. I think, you know, LATAM is an interesting area, but obviously you got the big question about Brazil.
Right, absolutely.
And you don't think that's going to hold the rest of the region down?
So Brazil is absolutely a political play right now, right? And I would think that the market is actually pricing a little bit too high a probability that we get an impeachment, which would then lead to a new government, or at least a replacement president, and a potential fiscal adjustment, which is very important, which would be very bullish. But Brazil is probably one of the weaker spots on LATAM. Certainly, the stabilization in oil and commodity prices has made things look a little bit better for Mexico and a little bit better for places like Colombia and Chile. But still, until we get that pickup in global demand and stabilization in Asia, it's really hard to get bullish EM.
Yeah, and Jonathan, I think one thing that's hard, emerging markets isn't a single thing. Right. I mean, it's a basket of, you know, regions of countries. And so when we look at EM, it really is South Korea, Mexico, and South Africa are really still the leaders. China's coming up, and it may be a huge part of the index.
Just digging into that, though, and to get across to Matt Miller, to break down the BRICS acronym that we've all loved to hate over the years now, just looking at some of the valuations of Brazil, a lot of money has gone in there.
Yeah, huge. I mean, this is the price to earnings ratio of the Brazil divided by emerging markets LATAM. So relative to its peers, it's at the highest PE level that it's been basically since, 1995 here. And then for U.S. investors, Brazil's so expensive right now because not only has it run up like 22% year to date in its local currency, but the real is up like 17% year to date against the dollar. So it's up like 35% year to date if you put it in dollar currency.
So to button this up, it's not just one thing, EM. Is there one you like? Pick one.
It would be very difficult. I was very optimistic on Mexico with all the constitutional changes, but the implementation has been really rough. And I think it's interesting when you look at emerging markets and you look at oil. They've been very highly correlated to the movement in WTI.